All right, thanks so much for joining us here at Investing City. We're going to be going through with my fiance some questions that she had and her friends had, beginner investors who just want to know more about the stock market and investing in general. So tune in and I'm sure you'll learn a lot.
What's the least expensive stock out there? How much money does someone need in order to start investing? Is it, one share is at least $100, so you need at least $100, or is there's a $50 one, or is there a $1,000 one? How much money does someone need to have in order to start investing?
Yeah, it's a good question. It really depends on the company. So just to give some context, Amazon per share is like $2,300, or there's also stocks out there that are $5. And so it really depends on the company. So I say that I think you really need like $100 to invest. Maybe you buy one share of a company that has a share price under $100, and there's tons of stocks out there with that. And you won't be making a crazy amount of money because a good return in the market is 15%. So if you put in $100, after a year, maybe you're making $15. And to most people, that would be like, I'm wasting my time. What's the point of this? But it really is all about the long game. If you can compound 15% for 5 years, that's double your money. If you can do that for 10 years, it's quadruple, 15, 8 times, 20, 30. It really compounds over time. So if you can start small and learn, I think that's really the most important thing. Kind of to go off of that, I think a lot of people, if you really don't care about doing the research of an individual stock, it probably makes sense to just buy something called the S&P 500 index. So it's similar to the Dow Jones, except it's a collection of 500 stocks instead of 30. And that is really what people talk about when they're talking about the market. So you can just buy into that index and it's all your diversification right there for you. And that would be considered passive investing because you're not actively picking individual stocks. You're just picking that index.
Okay. Does that index change? Do they add and sell different companies from there?
Yeah, that's a good question. So it does over time. It happens if, let's say, because it's considered market cap weighted. So basically the biggest companies have the highest share of the index. And if a company is really small and absolutely just does terrible, it can actually get thrown out of the index, and companies can be added to the index. But it doesn't happen super often.
Okay. Is it better, say I want to do active investing and not just invest in the index, S&P 500 index?
Nice.
Is it better that I invest, is it better that anyone invests in companies that they know and love and are passionate about them, or is it better to invest in companies that like you just hear everybody talking about and it's like, oh, okay, I should probably invest in that because everybody's investing in that?
Yeah, that's a really good question. I think that in terms of companies that you're really interested in versus you think they're popular, I think the companies that you're really interested in are a great place to kind of start finding investment ideas because you're going to be more interested in learning about these companies. If you hear about a popular oil company, but you don't care at all about oil, it probably doesn't make sense because you're not going to be interested in learning about it. One of the first books that really got me interested in investing was a book by an author named Peter Lynch, and it's called One Up on Wall Street. And his whole idea was you can kind of observe the world around you and find out those companies that are really doing well, and then do some research on them and kind of figure out if they're a good investment. And so I think the first part of your question is kind of the cultural phenomenon or just observing those companies because you see them being really popular. But I think the second part is being able to sort of do the research and kind of know, hey, is this a really bad idea if I'm investing in this? Or is this actually a pretty good idea? And there's just some small things that would be a good idea to know. Like if it has a ton of debt on its balance sheet, the company is way more likely to go out of business. And we've kind of seen that with the airlines during this whole thing. And they have debt loads, and so they have to get help from the government. So some small things like that would help you do the research. There's a great saying that basically, if you knew everything about a company, there would be no risk because you could kind of price it in. So I think it's great to just learn a ton about a company, and then you would probably do pretty well in that company.
Okay. And how do you go about learning about that company?
Yeah, so this is where it really gets sort of detailed, but the first thing I think that's really underrated is just understanding how the company makes money. So there's a website called Edgar, and it's a government website where you can actually type in the name of the stock and it'll pull up all the documents, and it'll be these crazy symbols like 14 DEF or 10K or 8K, and you want to find one that's called 10K. And I see your face saying this just sounds really boring, but you can just type in Amazon 10K. You can just do that on Google, Amazon 10K, and you can pull it up, and there will be a table of contents, and the first section will say business. And you can just click on that, and it'll take you right to the business section, and it'll probably be 10 to 15 pages. And you can just read about how the company makes money, how they distribute their product, how they manufacture it, if they are manufacturers. So just kind of understanding, what does this company do? I mean, you can kind of understand from a high level how an airline works or a grocery store, but just kind of making sure you understand it. You should be able to, in 1 minute, tell somebody exactly what a company does. So that's the first thing. And then I think going through the financials, there's varying ranges that a lot of beginner investors have to go through. Like, I don't expect beginner investors to kind of go through all the financials and make sure they've done everything. But there's a few things like looking over the revenue. If revenue is declining, that probably means that something's up. The company is not growing. So you want to essentially, there's a great website called StockRow. You can go to stockrow.com, type in the name of the company, and you can just look real briefly at, is revenue going up? Is earnings going up? And you don't really have to know anything about the company. But that would be a great place to start, looking at the business section of the 10K and then briefly glancing at the financials.
And what is that? How is that different from what, like when you're on Robinhood, for example, or whatever brokerage, and it shows you can look at the past year's performance? Is that different than going and looking at their financials?
Yeah, that's an important distinction, because a lot of times the stock price, so that line you see on the brokerage, is driven by the underlying fundamentals of the business. And so if Amazon grows its sales at 30% and profits rise even more than that, the stock price will probably follow. And so the stock price is actually a lagging indicator of the health of the financials of the business. And so you want to ideally look at the financials and the source of how the business is actually doing versus just how the stock is doing, because a lot of times the fundamentals and the stock price can get out of whack. Because, I mean, we've seen this with a company named Zoom. A couple weeks ago, there was all these concerns about the security of their platform, and people were saying that data centers were in China, and the stock sold off like 20%. But if you actually look at the financials, I mean, they've been doing incredibly well. And so you can kind of see that sometimes the stock market and the price is much different than the actual fundamentals.
Okay. And this might be somewhat redundant, but from redundant going back to one of our first questions, say Amazon increases sales 30%. How exactly does that translate into their stock going up?
Yeah, I think that's a core question of the stock market. So essentially, the stock price is, so the value of the company is considered something called the market cap. And the market cap is made up of two things, and that's the price of the stock and then how many shares of the stock. It's something called shares outstanding. So if you had a stock that was worth $10 and there was 100 shares outstanding, the market cap would be $1,000. And so for a company to double in price and the shares stay the same, that means the stock price is now double. And so if you think about the value of a company, companies are valued based on So the value of a company, this will sound very sort of jargony, but it's the present value of all the future cash that the company generates. So just like any asset, basically it's all a sort of compensation stream from the future. So if you were buying a bond or something and the coupons, the amount of money that you get every year, were way higher than another bond, all is equal, you would pay more for that bond. And so basically, as the company generates more cash, the value of that company increases because it's serving more customers, it is paying employees, it's doing all these things that make the company more valuable. So it's essentially a function of how much cash investors think the company will create in the future.
Okay.
Is that clear?
Yeah, and then the people deciding the value of the company goes back to the, what was that word you used? That, there's kind of, does it go back to similar to the demand for the stock?
Yeah, supply demand, right. So if a lot of investors think that this company performance has been amazing, they've grown revenues, grown earnings a ton, there'll be more demand, and so the stock will rise.
Okay. And are there people that are like, oh, there's a lot of demand for this, we should raise the price? Is that how it works?
It's basically how willing people are to sell in that case. If the stock is going up and there's a lot of people that are sitting on the shares and they're not selling at all, then those people that want to buy those shares are going to be offering them more and more money until they hit a price where it makes sense for those people to sell.
Okay.
So there's something called a float, basically how many shares are openly traded. And so some stocks that have really small floats, essentially not a lot of people that can even sell the shares because they're locked up from management or whatever the case may be. Sometimes those stocks can see big moves because there's not a lot of people that are willing to sell, and so the stock just keeps going up before people start selling. But it's not really like super black and white, because you'll just check the stock market and be like, oh wow, the stock's up 5%. Should I sell or buy? And based on all of the aggregate totals of those buy and sell decisions, the stock goes up and down.
Okay.
Yeah.
Oh, okay. It's like a whole other world.
Thank you so much for watching this video. If you enjoyed it, please like and subscribe to our channel, and please leave a comment below for any other questions you have. Please stick around to get all of the knowledge that you can. You're awesome.